Hey guys, this is Mrs. Schoenberg. This is the review for our next test, which covers Chapter 8 and Chapter 9. There is actually not going to be any of Chapter 10, so it's just Chapter 8 and Chapter 9. There are 4 true-false problems, 4 multiple choice problems, and 5 exercises or problems that require journal entries. It is taken out in Cengage, 75 minutes, 1 attempt. The password is spring exclamation point. Okay. So on this first square here, here's some definitions you need to know. Anything here. Also, no definitions for maturity value, face value, what they are, and how to figure. One of the big problems is you're going to be journalizing the direct write-off method, and you're going to journalize the allowance method. So let's do one of these together to recall, because the problem on the test is pretty much like this one, okay? So remember, when we do the direct write-off method, it's just we automatically hit bad debt expense and write off the receivable. So April 1st, this is actually recording the sale. They sold some merchandise to Henry Ford, $6,600, cost of goods sold is this. So to review that, the journal entry on April 1st is AR Henry Ford, $6,600, and record the sales. And also the second entry for the first is to hit cost of goods sold for 2,200, or excuse me, 4,200, and inventory gets the credit for 4,200. Okay, so that's the April 1st entry. Then on June 10th, they received payment for 1/3 of the receivable and wrote off the remainder. Okay, so 1/3, if you take the 6,600 and divide it by 3, 1/3 of that is 2,200. That's the part that they received payment on, the cash. Okay, so on June 10th, got to record the cash of 2,200. That's the debit. The rest is written off to bad debt expense, which is 4,400. And then the credit goes to AR Henry Ford, total 6,600. That's the June 10th journal entry. Then October 11th rolls around and Henry Ford paid. So we're going to reinstate just the bad debt part, the 4,400. That's the first part of the entry. So October 11th, we're going to reset up the AR for Henry Ford, but only for the amount of 4,400. And we're going to credit bad debt expense for 4,400. Then we're going to apply the payment. So they did get cash of 4,400 and clearing out that AR for Henry Ford in the amount of 4,400. Okay, that was the direct write-off method. We are also going to do the same problem, and this time you need to know how to do the allowance method. So I guess what you need to recall here is when the allowance method happens, you set aside this amount into this allowance for doubtful accounts. So when you actually write it off, you write it off against the allowance. Okay, so again, April 1st, they made the sale. This is exactly the same. AR Henry Ford, 6,600. Sales, 6,600. Also on the first, cost of goods sold, 4,200. Inventory gets the credit for 4,200. That's the April 1st. June 10th, again, received the payment of 2,200, wrote off the remainder. Okay, so June 10th, this is a 3-liner. They did receive cash for 2,200. They received cash for $2,200, and then they wrote off, this time it's to allowance for doubtful accounts, $4,400, and then clear out the AR for Henry Ford for the full amount of the $6,600. All right, then October 11th rolls around, and they received the $4,600. That should actually be $4,400. That should be $4,400. They received the $4,400. Okay, so October 11th, we got to reinstate. So we're going to reset up the AR for Henry Ford, but only for the $4,400, and we're going to reverse out the allowance for doubtful accounts for $4,400. That's a credit. First one's a debit. Now we're going to apply the payment. October 11th, received cash, $4,400, and we'll clear out the AR for Henry Ford once and for all for $4,400. Okay, that kind of shows you the difference between the two methods. That's going to be big points on the test if you can get that. Also on the test, you'll have one of these where you're going to determine the maturity value, the date of the note receivable at maturity, and you're going to journalize the entry to record the receipt of the note and the payment of the note. Okay, let's look at this example. Peak Designs issued a 60-day 8% note for $60,000 dated April 27th to Bork Furniture Company. And then there's the assumptions. Okay, so let's continue on the next page. And if we have a 60-day note, and when is it going to come due? Well, it started April 22nd. Okay, so April 22nd, 30 days. 60 days would be April 22nd, May 22nd, June 22nd. Then you have to ask yourself, did April or did May have any months that had 31 days? And May did. May had 31 days. So you need to subtract 1 day, and you end up with June 21st. Then to determine the maturity value of the note, you take your 60,000 times your 0.08 times 60 divided by 360, and there you get your interest, but that's not your maturity value. You're going to add your interest to the face value of the note, so the maturity value is going to be $60,800. And when you journalize to record the receipt of the note happens on April 22nd. You're going to debit notes receivable for just the amount of the face value, $60,000, and you're crediting the AR for Bork Furniture. You're basically taking it out of their AR and you're putting it into a notes receivable. Then when they pay it, which that date will be June 21st, it looks like this. Cash received, $60,800. Credit the notes receivable for the $60,000, and then credit interest revenue for the $800. Okay, also you're going to need to know these two bullet points. You do not need to know anything that says chapter 10. There is no chapter 10 on this test. So those things you don't need to know. There's a problem where you're going to convert following estimates of useful life to a straight line depreciation rate. So remember how we would take 100% divided by 2 in this case for 2 years. The answer in this box would be 50%. So this one, 100% divided by 8, the answer would be 12.5%, so on and so forth. All right, one more to go here. This is our equipment one. Equipment purchased at the beginning of the fiscal year for $180,000 is expected to have a useful life of 5 years or 10,000 operating hours and a residual value of $5,000. Compute the depreciation for the first and second years using the following methods. So for straight line, remember on the top, all we do is we take the 180,000 minus the residual value, and divide that by the number of years, 5, and it's the same amount every year. So for straight line, it ends up being 35,000 per year. So year 1, 35,000, and year 2 is 35,000. For the units of output, we have to figure the depreciation rate. And if you remember, the top is the same, 180,000 minus 5,000. Then you divide it by the total units of output, which they believe to be 10,000 hours. So once you do that math, you come up to $17.50 per hour. Then you take the 800 and the 1700. So 800 hours times 1750, the year 1 depreciation is going to be 14,000. And the year 2 depreciation, you take 1700 hours times 1750, and the year 2 depreciation is 29,750. Finally, double declining balance. We take the straight line rate and we double it. So we take 100% divided by 5, and that's 20. So doubling that, we get 40% for the double declining rate. Then I like to draw my chart. We have year 1, year 2, beginning value times the double declining rate equals depreciation expense, and then we have our ending book value. Okay, so the beginning value of this thing is 180,000. We're going to multiply that times 40% to get our depreciation expense in the first year of 72,000. Then to get our ending book value, we have to take 180 minus our depreciation, and our ending book value is 108,000. Bringing that forward, 108,000 times 40% is going to be 43,200. These are our two numbers for depreciation expense using double declining method. Okay, so I hope that helps. And those are some big problems, but if you do the study guide and have this available and study it, you'll do great on the test.